In the intricate web of today's global economy, financial reporting emerges as a crucial tool that transcends mere numbers on a balance sheet. It serves as a window into an organization's financial health and operational efficacy, enabling stakeholders to make informed decisions. The significance of financial reporting cannot be overstated. It provides transparency, fosters trust, and aids in regulatory compliance, ultimately contributing to the sustainable growth of businesses and economies alike. Financial reporting plays a vital role in enhancing transparency within organizations. By presenting a clear and accurate depiction of financial performance, businesses can communicate their financial status to stakeholders, including investors, creditors, and customers. This transparency is essential because it builds trust and confidence in the organization. When stakeholders have access to reliable financial information, they are more likely to engage with the company, whether through investment, lending, or long-term partnerships. Thus, transparency through financial reporting is foundational for maintaining and nurturing stakeholder relationships. Moreover, financial reporting is indispensable for informed decision-making. Managers and executives rely on financial reports to assess performance, identify trends, and allocate resources effectively. These reports provide insights into revenue streams, expenses, profitability, and cash flow, enabling leadership to make strategic choices that drive business growth. By analyzing financial data, companies can pinpoint areas for improvement, invest in profitable ventures, or even cut losses in underperforming sectors. Hence, financial reporting equips decision-makers with the necessary information to steer the organization towards success. In addition to supporting internal decision-making, financial reporting is crucial for external parties, particularly investors and creditors. Investors use financial statements to evaluate the viability and profitability of potential investments, while creditors rely on this information to assess creditworthiness. Accurate financial reporting reduces the risk of misrepresentation and fraud, thus protecting the interests of investors and lenders alike. In this way, financial reporting serves as a foundational element of trust in the marketplace, allowing for the free flow of capital and investment. Furthermore, financial reporting is essential for regulatory compliance. Governments and regulatory bodies require companies to adhere to specific accounting standards and practices, ensuring that financial statements are prepared in a consistent and comparable manner. This compliance not only protects shareholders but also safeguards the broader economy from fraudulent practices and financial mismanagement. By adhering to these regulations, businesses demonstrate accountability and contribute to a stable economic environment, which is crucial for growth and development. Another critical aspect of financial reporting is its role in performance evaluation. Organizations use financial reports to measure their operational efficiency against industry benchmarks and competitors. Key performance indicators, KPIs, derived from financial statements allow companies to track their progress over time and adjust strategies accordingly. This continuous evaluation fosters a culture of improvement and accountability, ultimately enhancing overall organizational performance. Lastly, the importance of financial reporting extends to its role in fostering investor relations. Effective communication of financial health through well-prepared financial reports can attract new investors and retain existing ones. Companies that prioritize clear and transparent reporting can differentiate themselves in competitive markets, as investors are often more inclined to support organizations that demonstrate strong governance and accountability. This investor confidence can lead to increased capital inflow and market stability, contributing to long-term sustainability. Financial reporting is an indispensable component of modern business operations, serving multiple critical functions. It enhances transparency, supports informed decision-making, facilitates external evaluations, ensures regulatory compliance, enables performance measurement, and fosters strong investor relations. Together, these elements underscore the importance of financial reporting in promoting trust, accountability, and sustainable growth within the corporate landscape. As businesses navigate an ever-changing economic environment, the role of financial reporting will continue to be pivotal in shaping their success. Financial reporting remains an indispensable tool for businesses, investors, and regulators. It serves not only as a measure of past performance but also as a guide for future decision-making. As businesses grow increasingly complex and globalized, financial reporting standards, methods, and technologies will continue to evolve. The integration of ESG factors and the rise of digital tools are already transforming the way companies present their financial health, ensuring that financial reports remain relevant and reflective of the broader context in which businesses operate. In the complex world of business, where decisions can have far-reaching consequences, the need for transparency and accountability is paramount. Financial reporting serves as the backbone of informed decision-making, allowing stakeholders to assess the health of an organization. By effectively communicating financial performance, financial reporting plays a crucial role in fostering trust among investors, regulators, and the general public. This essay will explore the significance of financial reporting in promoting transparency, aiding decision-making, ensuring compliance, attracting investment, facilitating performance evaluation, and supporting strategic planning. The first and perhaps most critical aspect of financial reporting is its role in promoting transparency within an organization. Transparent financial reporting provides stakeholders with a clear and accurate picture of a company's financial health, including its revenue, expenses, and profitability. This transparency is essential for building trust among investors, employees, and customers, as it allows them to make informed judgments about the organization's performance. In an era where corporate scandals can devastate businesses, effective financial reporting serves as a safeguard, ensuring that stakeholders have access to reliable information. Consequently, transparency through financial reporting not only enhances credibility but also fosters a culture of accountability within the organization. Another significant importance of financial reporting lies in its ability to aid decision-making for both internal and external stakeholders. For management, accurate financial reports provide essential insights that guide strategic choices, such as budgeting, resource allocation, and expansion initiatives. For investors and creditors, these reports serve as vital tools for assessing the viability of their investments and the company's creditworthiness. By presenting comprehensive financial data, organizations empower stakeholders to make strategic decisions based on empirical evidence rather than speculation. Thank you for joining us on this financial journey. We hope today's insights have added value to your financial literacy. Remember, financial success is a journey, not a destination. If you enjoyed today's content, don't forget to hit the like button, share with your friends, and subscribe for more insightful videos.